Good morning. This is Jovine from Behind the Markets. Happy Monday. Today is January 13th. Hedge funds are dumping more stocks than at any time in the past year. That was the headline that caught my attention on CNBC. And it's not really a wonder why. Like them, we, a lowly little behind the markets here, we rode the lovely little market that we had last year. We took some great profits. We did very well, as you can see in our model portfolios. We've been warning that the market was really high. And here are some facts just to show that. The stock market's now worth $63.8 trillion, which is close to an all-time high. It's close to what it was just a month ago. The U.S. stock market's market cap has doubled in the last 4.5 years. Hedge funds are increasing their short position. There are some facts that I wrote down that I'm going to go. This is an interesting one that I did not know. The S&P 500 price-to-book ratio hit 5.3 and officially has exceeded the level that it was at right before the dot-com crash. Now, if you really want to understand, price to book is a very valuable metric to think about when buying stocks. In our Midnight in America book that we published on how to handle the next crash we get, we really talk about how I use the price to book ratio to do very well on the 2009 market crash. I urge you to get yourself a copy. Okay, that's a commercial break. Now back to my list here that I've created for you. All right, the 10-year note, obviously I've been talking about that nonstop, is jumping 4.7%. Mortgage rates look like they're going to hit 8%. And again, since the Fed pivot began 111 days ago, interest rates are up more than 110 basis points. Here's an interesting little factoid that I captured for you. Buying a home in 2021 with a 20-year or 30-year mortgage meant you spent $473,000 in principal and interest. But right now, you're spending $873,000. That's a lot. U.S. existing home sales closed at 4.15 million in 2024, making it the worst year since 95. Wow. Bank reserves dropped by $326 billion, ending the week January 1st to 2.9 trillion. That's the largest weekly decline since April 2022. Oh, U.S. credit card serious delinquency rates for subprime borrowers have risen to 22% in Q3, the highest in over 12 years. That is significant. Consumer credit card debt has plunged the most since COVID. Basically, banks are pulling back from lending. They see this. We talked about gold rising, of course, ad infinitum. Here's another one that caught my attention. U.S. big bankruptcies hit 686 in 2024 as of December 23rd. That's the most in 14 years, the year after the financial crisis. It's really surprising. By comparison, in 2023 and in 2010, there were 636 and 828 filings. So bankruptcies are rising as if a recession is here. U.S. hires as a percentage of unemployment, too, also tumbled to 3.3%. So what we're seeing here is, underneath the data, we're seeing the job market get weaker. We're seeing unemployment start to really tick up. Openings are going down. We're seeing corporate bankruptcies that are really starting to shake things up. We're seeing lenders start to pull back from consumers. Subprime borrowers are in trouble, so they're starting to pull back. This is a sign that the economy is slowing down. And of course, Warren Buffett's sitting on $325 billion in cash. Look, at Behind the Markets, we really talk about all this. All of our portfolios have been trimmed. Our hedges are trimmed. We've gone out there and clipped the hedges. We've closed the shutters. We have our windows open, but we've closed some of them. And we feel pretty prepared for this. But one thing that we're not doing, and I urge you not to do, is go out there and do the kind of thing, when in doubt, don't pull the trigger on a stock that you're thinking about, the risky stocks. There are some great exceptional opportunities out there, really, and we're talking about a few of them. We've really dug really hard to find some of them. But don't swing at pitches outside of your strike zone. And if you haven't picked up a copy of Midnight in America, what I include in that book is my playbook for how to handle a coming market crash, the next market crash, or a real bear market. I am telling you, it is the playbook I am passing down to my kids. It is the playbook I have used to make a ton of money on, specifically in the financial crisis in 2008, 2009. So that is my message for Monday. We are on cautious alert. We play the ball where it is, not where we want it to be. If things change, we will change. We're not going to be fixed position fighters. We are going to move like water. This is how we do it. Anyway, that is all I have today. I will see you tomorrow.